Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in, take a look, see what people are sharing. If you want to follow me at _finance, and if you want to join our community, finding-value.com, where I dive deeper into all these topics, looking for investment um, opportunities, sharing those opportunities with everyone in the community. We do have a special going on. Special is the coupon code if you'd like savings while signing up on the monthly and yearly memberships. I'm going to start with Dave Kranzler. I'm starting to wonder if this tariff stuff is controlled demolition of the economy in order to justify a huge QE program, because I know the asset side of big bank balance sheets are highly stressed from bad loans and are at risk to the nuclear meltdown of their massive off-balance sheet OTC derivatives exposure. It's why they fabricated the C-19 crisis in 2020. I've come out. This is a while back that they were going to engineer a recession, and that this engineered recession could lead. And I didn't state this, but it is my opinion that it could lead to something like stimulus or QE or something on the lines of that occurring. But they needed some sort of event, a trigger event. Usually the yield curve inverts, which we have. When the yield curve uninverts, these events almost always tend to show up. And here we are with the yield curve inverted, starting to uninvert, and people are kind of wondering, like, hey, is this going to be like some sort of, we'll call it the tariff event, where we get a recession? It's for the most part an engineered recession. I, I, I don't think there's any time in history where I've seen anything similar to this, outside of 2020, maybe 9/11, but there isn't much in history where the yield curve uninverts and we see these weird things. Almost always the problems were driven by the real estate market. Um, we had the dot-com bubble. That bubble was pretty nasty, and that bubble was basically they were doing accounting fraud in the companies. They were booking future ideas and projects and programs, and getting cash flow from that. At least Enron was doing that. So kind of a little bit of a different weird setup in the 2000s than what we have today. But yeah, I agree with that. Nomi Prince says, we continue to stand by our forecast. We believe gold will reach 3,800 to 4,000 per ounce by the turn of the year, and 5,000 within 2 years. I don't think that's a huge call, in my opinion. I think you could do that. If we do get a recession and the yield curve uninverts, that's gold's wheelhouse. That's when gold turns it on. So I know some people are talking about a consolidation, a pullback. Oh, we need a consolidation. We need a pullback. I don't know, guys. That's really short term. Those guys generally get it wrong. There's a high percentage of being wrong in the short term with technical patterns. Your percentages, depending on the pattern that you're using, they range from about 50% to 80%. And it depends on your time frame that you use, the size of the pattern, what that pattern is. A double bottom versus, say, inverted head and shoulders versus a small continuation pattern. The smaller patterns generally fail more often. So gold's right now has a small pattern that is formed. It's not a big one. And the small ones are really hard to get right, because your statistical probability of being correct is pretty low. And anything can influence the short term. I mean, obviously, the tariff information impacted us in April. That was a pretty big move in a pretty short period of time. The oil market playbook forcing the inevitable, says HFI Research. He says, U.S. shale was already peaking before this tariff mania started. OPEC Plus, or the Saudis, added to the distress in the oil market by bringing forward fake production increases. The sentiment hit, coupled with worries over demand, is forcing the oil market to face the inevitable, is what he is stating. And we're going to talk a little bit about oil in this, later on in this clip here. So here's Clint, and I actually agree with Clint. He says energy stocks are a strong buy today. The assertion is separate from will they go down further. No one can time bottoms, and one of the quotes I like best is attributed to Graham and Dodds. The market is a voting machine in the short term, but a weighing machine in the long term. CapEx on growth is being restrained currently. Balance sheets for Canadian energy companies are strong. Buy when there's blood in the streets. They say oil with a five handle qualifies. The day-to-day price action of any asset defines its value only in respect of that day. Look out 12 months. Do you think oil is trading with a five handle? If so, probably best not to buy. But if you think oil price is higher, buying today makes sense. I believe oil price 1 year out is much higher than current consensus forecasts. See Bob Farrell rule number 9. I would agree with him. I actually would be a buyer over time to cost average in to oil. And everybody hates oil right now. Everyone hates oil. Go look at the comments section in these videos. Everybody will say, "Oh, oil is going to go to $30 a barrel. Oil's not good," and that very well could be the case. Maybe it does get down there. That is a possibility. But when you're buying value, you continue to buy value. You don't wait and try to time the price. That's what the big boys that are value investors will tell you. The Howard Marks, in fact, I think he has a direct quote saying that, and the Buffett types and the Peter Lynches, and all those guys. HFI Research, another one, says this is where we are headed for U.S. crude oil production. Drill baby drill is more like fall baby fall, and he's got a line down here of where he thinks oil is going to go to, which is down here in late 25 and 26, which is between 12 million and 12.5 million barrels per day production. He thinks it's going to fall. Now, that very well could be the case, and some people say, well, we're going to get in a recession and oil demand is going to go down. Well, you better check those recessions in history. We did not see a big decline in oil demand in either recession of 1990 to 1991 or 2000, 2001. The growth slowed down, but we didn't actually go down in oil demand. Oil demand did go down in 2008. So we had a massive, great financial crisis with deleveraging, which is deflationary, which did impact oil demand. But the other ones before that, the growth slowed on a worldwide basis. They did not have demand go down. It continued to go up. Now, if we lose production in shale and it goes down like this, that right that could be about 1 million barrels per day or so. 1 million barrels per day. I mean, we're going to get into Saudi export capacity here. Saudis maybe got about 1 million, 1.5 million, 2 million exportable capacity, maybe. That's it. We're going to be running at pumping capacity here probably in 26, 27. Pumping capacity. Now, some people are going to say, well, how could you be bullish on oil if it's down? It's down in the 50s, and we could be going into a recession. Well, that's when you got to get excited. You have to get excited when things go down, because what I'm talking about here is the fundamentals of oil. And in my interpretation, and maybe perhaps HFI Research's interpretation, there's other people who interpret it differently too. You can look at Goring and Rosenzweig, and you can look at Doomberg, who has an opposing opinion. Doomberg has an opinion that we're probably never going to have peak oil and that we're just going to go up, 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 and up, and up. I'm more in line, and I tend to be more in a more of alignment with Goring and Rosenzweig than I am with Doomberg. I think Doomberg is wrong. We do have peak oil, and the way that you would see peak oil is just look at one field. If one field peaks, that means that peak oil does exist because you can't infinitely extract out of one field. So if one field or one well peaks, that means that when you get a collection of all these wells, that eventually it will peak. The debate would then be, when does that peak occur? What does it look like? And that is a different debate. But looking at Goring and Rosenzweig's models, they are predicting a peak that has already occurred in 2024. So they're saying that this peak is already occurred and that we will roll over and head lower. Now, this year, they have added in natural gas liquids into their oil production to probably hide the peak. The peak occurred in 2018, which was back maybe as 2018 worldwide. This is 2019 here, but 2018 worldwide is when oil production peaked. We've been producing a lot more natural gas liquids to fill the gap, and people are now saying that the natural gas liquids and oil peaked in 2023-24 timeframe. So somewhere in this general area is what they are guessing as a potential peak. We'll see if that's right. I don't know. Coming down, we got Lynn Alden. She keeps posting this over time. Nothing stops this train. And what that means is fiscal spending. So this is the cumulative budget deficit by fiscal year. And look at our deficits for 2025. Up, 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 up. And what she's saying is nothing stops this thing. What is kind of weird is this whole tariff mess. I'm in the camp that she's probably right, that this fiscal spending can overpower a lot of things. But I can't say that I've looked at history and I've got all these examples of large tariffs being placed in the market and what the outcomes were. So we are going through a lot of uncertainty right now, and um, I can't tell you what they're going to do with tariffs. I don't know if they get negotiated, if they're going to change it. Who knows? No one knows that and exactly what's going to potentially happen there. But we'll see what happens. That's for sure. Here's another one from HFI Research. OPEC Plus is bringing forward the production increase is meaningless. It's always been a Saudi cut and will continue to just be the Saudi cut. So this is framing this another way. Here's the math. OPEC Plus crude exports in April of 23 was 30.03 million barrels per day. That was OPEC Plus crude exports. April of 2025, it was 28,003.325. The delta between April of 23 and April of 25 is 1.7 million barrels per day. Saudi crude exports, April of 2023 was 7.5 million barrels per day. Their April 2025 is 5.839 million barrels per day. That difference between those two, or the delta, is 1.661 million barrels per day. And he says, do I need to say more? He says, no, that's my point. It's never been a cohesive production cut. The cheaters have been cheating this entire time. So the only real production cut here is coming from the Saudis. That's it. So now this is an interesting thing here, because I think he's right. If he is right, that means that the only spare capacity in the entire world is what Saudi has. So then the question becomes, well, how much spare capacity does Saudi really have? Right now, they're producing at about 9 million barrels per day. They've held steady production at 10.5 million barrels per day. That's 1.5 million barrels per day delta. They say that their max capacity is at 12, but they've never held 12 million barrels per day ever in their history. So I'm not believing that they can do 12 million barrels per day and hold it steady. I don't believe that. So that makes me think if they're at 9 and they can produce about 10 and a half, 11 maybe, we're at about 1.5, 2 million barrels per day of spare capacity. Now, there could be a little bit more spare capacity somewhere in the system. If oil prices go way up, they could maybe scrounge around another million barrels per day or something, maybe. So that's kind of my opinion and his opinion on the mix. So really, OPEC, there's no opening the flood doors. It doesn't exist. The only flood doors are held at Saudi, and Saudi's got maybe 1.5 to 2 million barrels steady state production left in the system. Last time oil went up dramatically, we had between about 1 million and 2 million barrels per day spare capacity. And we had more inventory than what we have today. When we were at $140, $150 a barrel last bull market in 2008, we are actually in potentially more dire straits today than what we were back then. And perhaps maybe that's one of the reasons they're doing this tariff stuff because they know that. And maybe that's one of the reasons they said, you know what, we need to slow this all down. How can we do this? Well, we can throw big fat tariffs, and maybe there's multiple reasons behind it. Maybe they need to print money. Maybe they need stimulus. Maybe they're forcing Powell to lower interest rates. I don't know. There could be a bunch of reasons behind all that. Caleb Thomas says most agree that tariffs are likely to put upward pressure on prices, cost pushed inflation, and downward pressure on the economy. That's stagflation. Ugh. Not good for bonds or stocks. So stagflation is over here. Bonds go down and equities go down. We saw that in 77, 2022, a couple of these different areas. Bonds go down and equities go up in inflationary expansion. We got low inflation expansion, bonds and equities go up. And then recession, bonds go up and equities go down in this particular quadrants. Vancouver Island guy says $50 handles here. The question is now for how long? A good reminder today, this is Permian break-evens, and then add inflation and tariffs. So basically, a 5 handle puts that price of oil below the cost curve of the entire Permian. Everything in the Permian is below its break-even points. So this is just a matter of time before it goes back up. Now, could we get fear in the market? Could we get a scare where things go lower? We could. Definitely could. But right now, we are below the cost curve. And this is old data too. This isn't new data. Another one from Caleb Thomas. He says China's April PMI trade orders plunge. The trade orders is from the tariffs. So this is what's plunging, and this is what's potentially causing all of this problem. We saw a massive plunge in 2020. 2008 had a massive plunge. We're getting our plunge on right now for China's official PMI. The trade orders declining rapidly. EIA weekly oil report, the total U.S. oil inventories, excluding natural gas liquids, are declining and are lower than last year, even if WTI price isn't reflecting it. So the current data that we have today is that we are at very low inventory levels. The fair value for oil is probably around $95, $97 a barrel. That's fair value. Now, what the market could be doing is pricing whatever's coming up in front of us. It's forward looking. So what the heck are they seeing to get the price down where we are today? Is something that bad coming? Maybe it is. Maybe we've got something that is coming that's just nasty looking. With the trade wars that are happening with this tariff between us and China. So we'll continue to watch this. What I'm highly interested in is I want to watch and see what inventories do when we get into this trade, tariff, whatever you want to call it, war. I want to see it get through. I want to see the shipments come down, and then I want to see what the demand looks like. Then we can assess how bad it is. Right now, we don't know because those tariffs are not really fully implemented. We haven't seen the big pullback yet in container ships and the offloading and trucking of all those. So it might take a couple weeks to filter through the system. And that's what I'm going to be watching. Kobayashi letter says the Fed's worst nightmare just got worse. New data showed that the US GDP contracted by minus 0.3% in quarter one of 2025, while plus 3% or plus 0.3% growth was expected. To make things worse, the GDP price index surged to 3.7%, its highest since August of 2023. What does Powell do now? So we've got GDP that is pulling on back. And then we've got the GDP price index surging 3.7%, which is what it is below. He's stuck. He's stuck. He's stuck between a slowdown in the economy and an increase in the price index. And then we've got Trump throwing in these tariffs. Who knows if it'll blow this all up? It's tough to see there, and it could blow the price index upward, is what I mean by blow it up. He could blow this upward and blow unemployment up too at the same time. And Powell's going to be like, "What the heck did you just do to me? You made an impossible situation." Lawrence McDonald, CNN, the Trump White House is negotiating with itself. China has no interest in talking to Trump. Bonds are speaking a far different narrative, is a fact. And this is China's 10-year bond yield just collapsing lower. What does that mean? It means that people are running into bonds in China. But I also think that's demographic driven. They went through a real estate crisis. And with the demographic being smaller coming into home buying years, they're going to have deflation on their hands. So what people do is they run into the bond market because you can't generate the inflation with the demographic not being there. Kevin says, I'd rather have low yields on the national debt than the USA situation. Interest rate expense has the USA looking like it will soon be forced to intervene and monetize debts. Ponzi finance will have dire consequences. So we're going to have to create inflation because of our debts. It's called monetizing the debt. Monetizing debt means you create money, buy the debt, and that's what he's talking about, Ponzi finance and its dire consequences, which I think will put the pressure on the dollar to go down eventually. Christine says inventories don't matter as much as the OPEC plus forward guidance, is what she's saying with the oil price. It says, unlike crude, cracks don't chase narratives, and the crack spreads are up. What does that mean? It means that we've got a decline in oil, but yet we still have strong demand for the oil products, distillate and gasoline. But what I want to watch out in the future is when these tariffs start to bite, how does it impact the crack spreads? How does it impact oil demand? What do the inventory levels do when this all materializes? And that's going to, again, take probably a couple weeks to filter through. Here's the EIA inventory. We were down on crude inventories, 2.7 million. We are down on gasoline massively, 4 million barrels. And then distillates, we are up 900,000. So this is actually a very big draw. If you add in gasoline and crude, and you subtract the 900,000, we'll call it a million. So we drew 5.7 million barrels from those three in aggregate. That is not bearish. So if the market, let's say the fair value is $97 to $100 a barrel based off inventory levels. Our inventory levels are depleting, and we're drawing down these in we're drawing it down in non-drawdown season. This is like, if you were to ask me this, I would say that the world is already kind of screwed here. It's screwed because I think we already hit demand greater than our supply. And I'm not sure how they're keeping these oil prices down. Well, I know now, like recently, but I don't know how they were keeping them down for the election. And ever since the election, we're seeing this big disconnect between interest rates, the price of oil. We're seeing a disconnect between the fair value of oil and the inventory levels. What the heck is the market pricing in here with these tariffs? Like, are we going to see Armageddon in GDP, and are we going to see a massive demand shock for oil? I mean, it's difficult for me to see a three standard deviation of where we are today versus the future and how this all plays out. Um, there's got to be a demand shock coming that this market is seeing. What is it? What is going to go down here in this demand shock? I'm just kind of repeating myself thinking about it. Secretary Bessent says, just gave us a peek into the tax bill that Congress is working on. So let's see what they're working on. Here's what to expect. 2017 tax cuts are permanent. There's no tax on tips, probably because they're struggling to collect them anyway. No tax on overtime. No tax on Social Security. American made auto interest is deductible. For businesses, full expensing for equipment, full expensing for factories, deregulation, cheap energy, regulatory certainty. I don't know what cheap energy means. Like, what's that got to do with tax? Um, it just says cheap energy. So he also confirms that tariffs will work as a replacement for revenue for these tax breaks, in his opinion there. Energy Cynic says, smart money I chat with figures US will be down about 500,000 barrels of oil per day at 65 WTI exit 2024 to exit 2025. With a five handle, the bet that it's closer to 750 to 1 million barrels per day. A 2008 global recession killed 1 million barrels per day of demand for 6 months and resumed uptrend. We are setting up for a hell of a snapback in 2026 for oil prices. I agree. Now, you have to buy when fear's in the market. And have we hit total bottom? I don't know about that. Maybe it comes in May or June or whatever. But we don't have inventories that are. We're not falling over inventory here, guys. Whatever's being priced in, people are expecting demand to get smoked. Now, '08 global recession killed only 1 million barrels per day. With the five handle, that is a million barrels per day that will probably get killed in shale supply. So Saudi, they've got what, 1 to 2 million barrels per day of capacity. That's it. Then we're at pumping capacity of the entire world. 2026 onward is going to be absolute. It's going to be a one show to watch, is what I'll say. It's going to be a total clown show because something's going to happen. I don't know. Container bookings from China to the U.S. are collapsing. Bookings for the standard 20-foot shipping containers from China to the U.S. fell 45% year over year in mid-April, according to VIZION. Visit. Next will be trucking demand drop, leading to empty shelves, lower sales, layoffs, and a recession. This is container bookings from China to U.S. falling rapidly. This is March 3rd right here, and this is April 7th. This is 1 month. Look at the drop off here. My Lord. Now, could this result in a recession? Definitely. Definitely something's going to happen here. I mean, that is that's a very strong uh, fall off there. Trump's trade war driving synchronized weakness in US and China economic data, leading to synchronized weakness across the major pro cyclical commodities, with copper and crude leading today's weakness. Gold, meanwhile, is falling further as China bidders through ETFs have gone on holiday until 6th of May. So, if we do get a recession, this is definitely positive for gold. Gold is the one that benefits from this, and potentially the gold silver mining companies could do very well. Some of the commodities like copper and crude, you would see them pull back, um, and that's exactly what we're seeing. Lyd Alden says, I was thinking that $60 a barrel is a good time to fill up the strategic petroleum reserve. But looking into it further, apparently it'll take years to refill it. It's easy to put a lot of barrels into the market, very hard to refill it without impacting the price. If we don't have the spare capacity, I don't know how they're going to fill this thing up very quickly. It's going to be a lot harder to do that without impacting price. Jim Bianco states, the general understanding is that the economy, the hard data, is currently okay. However, it is expected to hit a wall 90 days from now based on tariff-influenced soft data surveys. This is something we've never seen before. In 90 days, this is 90% or 10%. I'm not sure what that means, but I'm guessing he's saying 90% to 10%, poly market odds. Oh, from 10% down here, perhaps all the way up to 90%. So big move on what's coming, and it's all based off of future projections. It's not the data hitting today. It's all based off future things that haven't occurred yet. And I'm wondering how well they've projected the future stuff that's ready to hit. We've got freight futures, AM update. So dry bulk, Capesize and Panamax both up 1%. Tankers, VLCCs flat, and Suezmax is down 1%. Energy Cynic says the whole energy complex is too focused on nominal versus real WTI price. Since 2019, inflation has been 27% cumulatively, implying that $60 WTI today is 47 bucks in 2019. There's only two periods that have been worse in the last 25 years. C19 and the bottom of 2016. The only two times. Chart inflation adjusted. I would say that this is actually down lower. We're going to do a shoulder, a head, and then like some shoulder that's developing here. And looking back, we did do stuff very similar. You can see this fractal there. We had a move up, and then this move lower is the move lower in 2001 recession. I think that's exactly where we're located. It's like a 2001 recession that we are going through right now. The only thing that's different, though, is that tariffs is a man-made applied thing. That was an actual slowdown in the market. This here is like an engineered recession. So whatever is being manipulated or controlled through tariffs can also be reversed, can also be negotiated, and things could look very different very quickly. I'll just throw that out there. Apparently, the Biden administration drained the SPR so rapidly that they damaged half of the oil storage caverns. They are being repaired right now, and others are being used to slowly refill the SPR, says Secretary Wright. Here's no FUD, but after the next halving, if price doesn't catch up to mining cost, what's the incentive for miners to continue? So Bitcoin mining now just totes unprofitable, costing over $137,000 to mine just one BTC in the US and near 200,000 per coin in Germany. Some people tell me that I don't understand the halvings and the how it gets adjusted in terms of the difficulty when mining. I'm just going to say this. Why does it continue to go up in terms of its mining cost? If this continues higher and the price of Bitcoin goes way down, you're going to have astronomical fees to be applied to those that want to exchange Bitcoins. This will be the downfall of Bitcoin. You are looking at it right here. This is what I think will be a major problem. Fake news, oil is going negative according to the market. This is total product demand. It keeps going up, looking backwards, at least into February. We are at, this is 41 countries, looking at the average below there, and we are continuing to go way higher than previous years. This one here is demand in Italy, Germany, Chile, the United States, India, Japan, and the UK. That's the countries that are in this. Is it time for coffee to make a fresh leg higher? That's looking pretty solid. So there are other commodities looking stair stepping higher here. And that's what I've got for today, guys. So that's all I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Use special as coupon code if you'd like to join. We've got a Sunday question and answer session coming up at 5 p.m. Mountain Time. We'll see you guys there. See ya.